Hi there. In this video, we explain the latest ISA updates from the Spring Statement 2026 and how they affect tax-free investing in the UK.
What if I told you that by 2028, millions of us could be paying 40% more tax on our savings without a single tax rate actually going up? It sounds a bit crazy, right? Well, the recent Spring Statement has unleashed what's called a stealth tax on savers. But, and this is the important bit, it's also opened up one final, really crucial window for you to protect your money. So in this explainer, we're going to break down the new ISA rules and the one deadline you absolutely cannot afford to miss.
Okay, so let's get right to it. The big question on everyone's mind, can you still pop that full 20 grand into a tax-free cash ISA? It seems like a simple question, doesn't it? But the answer has just changed, and pretty dramatically. And it all depends on how fast you move.
And here's the answer, plain and simple. For this tax year, yes, you absolutely can. But next year, no. For most of us, that door is going to slam shut. The crucial thing to understand is this. There's a window of opportunity, and it's closing. Let's get into exactly why.
So to really get why these ISA rules are changing, you've got to understand the bigger picture first. See, there's something called a stealth tax squeeze going on, and it's making your tax-free savings more important than ever. I mean, it's basically becoming the most important tool in your financial kit. Okay, the official term for this is fiscal drag, and honestly, it's a pretty quiet, kind of sneaky way for the government to take in more tax. Think about it. Your wages hopefully go up with inflation, right? But the tax-free goalposts, they don't move an inch. And what does that mean? It means more of your hard-earned cash gets pulled over the line and ends up with the tax man. Right, let's see how this actually hits your wallet. Your tax-free personal allowance? It's frozen solid at £12,570. It hasn't budged, and it's not going to for years. So any pay rise you get, well, it gets pushed straight into a higher tax bracket. And you guessed it, it's the exact same story for the higher rate tax band. That threshold, £50,270, is also frozen solid. So suddenly, that pay rise, it should feel like a great reward. Well, it could easily tip you into the 40% tax bracket. And boom, a massive chunk of your raise is gone.
And here's the other side of the squeeze. It's a bit of a double whammy, really. While your allowances are stuck in place, just look at what's happening to taxes on any savings or dividends you have outside of an ISA. Those rates are actually going up, which, of course, makes that tax-free ISA wrapper more valuable than it's ever been.
So with all these taxes creeping up everywhere else, this current tax year, that's April 2026 to April 2027, becomes this really specific and probably final opportunity for your cash savings. For this tax year and this tax year only, that full £20,000 allowance is all yours to play with. You can stick the whole lot into a cash ISA, pop it into a stocks and shares ISA, or, split it any way you like. The key takeaway here is that this is the last year that rule will apply to everyone. Now, it's not all doom and gloom. There is some good news. The rules have actually become a bit more flexible. See, you're no longer stuck paying into just one of each type of ISA every year. This is great because it means you can chase the best interest rates by opening new accounts without all the hassle of transferring your old pots. Okay, but all of this is really just the build-up to the single biggest change on the horizon. From April 2027, the whole landscape for cash savers is going to be completely different. It's all because of a new cap. And here you can see it, clear as day. From the 2027/28 tax year, if you're under 65, the most you can put into a cash ISA each year gets slashed from £20,000 right down to just £12,000. That's a massive 40% cut.
But here's the really interesting little twist in all this. Your overall £20,000 ISA allowance, that's not actually changing. The government isn't taking it away. What they're doing is, well, they're kind of redirecting how you must use it. They're giving you a pretty strong nudge to put that remaining 8 grand into investments, like a stocks and shares ISA.
And if you're already thinking about loopholes, well, they're one step ahead of you. To make sure people don't just use a stocks and shares ISA as a sort of hidden cash account, they're bringing in a whole new set of rules. You won't be able to just shuttle money back from investments into cash, and you can't just let it sit there as uninvested cash either. They're really closing the door on that. Now, look, it's a big change, no doubt about it. But as Martin Lewis from Money Saving Expert has pointed out, it's good to keep things in perspective. For a lot of people, being able to save £12,000 a year, completely tax-free, in cash, well, that's still a pretty decent whack. Okay, so that covers the what. But what does this all actually mean for you and your own saving strategy? let's talk about how you might need to start rethinking things.
So this is basically the new normal for anyone under 65 who wants to use their full ISA allowance from 2027 onwards. It's no longer a simple choice of cash or shares for the whole amount. If you want to use that full $20,000, it's going to be a compulsory split.
So who really needs to think about taking action right now in this tax year? Well, if you're a freelancer and you're building up a pot to pay your tax bill, or maybe you're a homeowner saving up for a big renovation, or an employee with a bonus on the way, this is basically your last chance to shelter the full £20,000 in risk-free cash, completely tax-free.
And here's a quick professional tip, especially for any company directors watching. Remember how we saw those dividend tax rates are on the up? Well, that makes using a stocks and shares ISA to shelter any investment income an absolute no-brainer. It's just critical now for keeping your personal tax bill down.
Right, it's really important to remember that these ISA changes aren't happening in isolation. They're just one piece of a much, much bigger puzzle of tax changes that could affect your entire financial life.
I mean, just look at some of the other things going on. The lifetime ISA for first-time buyers is being totally replaced. There's a new cap coming in for a popular type of inheritance tax relief. The rate for capital gains tax when you sell a business has gone up. It all just goes to show that having a smart, joined-up plan is absolutely essential right now.
So what's the takeaway here? It all comes down to a simple 3-step action plan. Step 1, review your own savings goals. Do you want to max out your cash position while you still can? Step 2, if the answer is yes, then you need to use your full £20,000 cash ISA allowance before that deadline on the 5th of April 2027. And step 3, it's probably a good idea to seek some professional advice to build a personal plan that works with all these new rules.
And really, that's the big question that all of this leaves us with. The window on easy, tax-free cash saving is definitely closing. The government is quite deliberately pushing savers towards investing. It's a huge shift in the UK's savings culture. And the final question is pretty simple. Are you ready for it?
Well, we hope this explainer has helped make sense of these really crucial changes. Of course, everyone's situation is different, so if you'd like some advice that's tailored specifically to you, please do get in touch with us. All the details are right there for you. And to make sure you stay ahead of the curve on any future tax changes, why not subscribe to the MTA YouTube channel for more updates?